This model is trying to focus on how you plan a bunch of these and drive high level economics on each of the main things. So when you drill a hole, you've got one-time costs. You've also got exploration costs that might go on for months. Then, if you find a successful hole, you have to build extraction uh, equipment or implement extraction equipment, which it has a one-time initial cost and then ongoing costs as well. And these are big operations, usually millions, hundreds of millions, possibly billions of dollars. So these high-level items drive many of the variable costs. Then you could define how much of the production is kept. This is if you have to pay royalties to the state or landowners. Um, then you start with an initial production per day, which is the flow rate, and then there's some monthly decline in that production. It's exponential decline. That's the most common curve to define essentially how the flow rate changes from the beginning, and it will go down over time. Then you have the production or the selling price of the units you're selling or if it's gas or oil or whatever. So all of that combines, and we see this. We've done all the logic here in these matrix tabs. There's a lot of stuff going on here, which I already built in the last couple. I think part part 2 and 3, well, 3 and 4 definitely involved doing all of this and then getting it into the monthly detail. So what we're going to do now is we have to build out more fixed costs for operations. This is more like corporate stuff. Uh, we'll call it fixed costs. Now, the tough thing here is to decide what goes into like a capital asset and is depreciated versus not. And the only effect that will have on cash flow is it will affect the depreciation, which is going to affect taxes. I've decided in this model we're going to mainly focus on just the cash flow. We're not going to really worry that much about um, three statement modeling or uh, we are so what I'm going to do is allow the user to hard code in the expected taxes. There's no need to hard code in the depreciation. If you were going to do that, um, you would then the taxes would not be expected. You'd have to use the other stuff, and there's a little bit too much going on to try to determine automatically taxes and depreciation. And that's because mainly these one-time and ongoing costs might involve capital assets, and some of it could be capital assets, some of it could be labor and things that are tax deductible immediately. So we're not even going to get into it. We know these costs, the timing of them, which is the most important thing for cash flow. And then the user will be able to go in here and put in what the taxes they expect to pay are on a monthly schedule. And then there'll just be an item that says, here's your cash flow. And what this allows us to do is create a nice internal rate of return calculation. We can plug into a nice waterfall, and it's just going to show, okay, here's what the equity requirements are. There's no debt funding. Um, Here's what equity requirements are, and here's what the cash flow distributions are. That'll run through a waterfall, which is typically used in oil and gas joint ventures, just very similar to real estate because it's got a very predictable income stream. A little different though because we're not defining an exit value based on anything. It's just going to be you're going to eventually stop operating, or you can run these cash flows until they're not the wells are not producing anything anymore, or they're not profitable, so you have to stop it. And then what you'll do is just look at those stream of cash flows and see what the ROI is, IRR, and we'll do that for the project level. And we'll also do that we'll set it up in a GP and LP structure for waterfall with IRR hurdles. The most difficult thing of this model is done now, and I think this is super valuable for anyone looking to do a quick analysis of drilling a bunch of wells for oil and gas. Um, and you can plug in your high-level details here. These will be management costs, like fixed costs, legal fees, things that are basically not directly related to the number of wells in oil being drilled. So let's get these in here. So fixed costs, you can just take a general fixed cost schedule. What's a good one here? The jewelry shop, I think would be fine. So this is generic, fixed and other costs. Now this is only a 5-year. We'll have to extend it. We don't need these over here. I'm not going to separate it out into sales and marketing, general administrative, and research and development. We're just going to go have these cost items here. You can simply pick the start month. And this will be based on our 120 months period. Oh my goodness, I forgot to, where's our dates at? I forgot to um, do the intro about smarthelping.com. I felt like I was forgetting something. It's Monday morning. I'm kind of all over the place here. Okay, so before we continue on the oil and gas financial model that we're working on here, that will be part of the startup financial model or industry specific financial model bundle on smarthelping.com. I'll put it in here with these. I'll probably price it at, oh, I don't know. I think probably I'm leaning towards a $75 price point for the template, and I think that's fair for what it's going to do. And remember, if you want to buy all the financial models or buy by category, you can check out the financial models tab at the top. You can buy everything I've ever built for $9.99, and you pay once and access everything forever, and that includes future builds. I've got a lot of SaaS and membership subscription forecasting models, real estate, um, industry specific, joint venture waterfalls. Now these are nice because you just plug in your data at the top and it does all the logic and math for you. Accounting tools for tracking things. Accountants would use all of this. HR management trackers, personal finance, Google Sheet templates, sales pipeline KPI, a lot of dashboarding here, database stuff, uh, querying databases and analysis, and general valuation. So there's tons of value here if you've never used spreadsheets or if you do use them and want to see, the full capabilities. This is a great value here to purchase. Let's send this link out to Twitter, even though I know I'm late. Glad the sound's working. Live financial modeling, oil and gas exploration. Okay. Now, back to it here. So we've got fixed costs. Now we're going to go over for 20 years. And this just lets you drop in the expected monthly costs in each year. You could do any kind of growth rate and you could adjust that by type. There's not any payroll tax benefits specifically. So if you're doing a salary item, you can include the fully loaded costs. Or let's customize this, or you can group all your salary items in one spot. Like say these are all salaries, and then you can make the next row the sum of all this times whatever percent for payroll tax and benefits, uh, which is fine. Let's add some more slots here since, yeah, we'll go down a bit. Just stagger these so we can make sure the logic is working. So we've got how many slots here? 167. That's probably overkill, but overkill's better than um, not having enough. So that's completely fine. We will lock or freeze these. So here you just simply pick the start month that the cost begins, define the cost, and what is that cost over the 20-year period. Pretty simple. I'll widen this out a little bit. And there's your fixed cost schedule. We could drag this down. Now I do also want to put another miscellaneous that says, you've got other costs as a percentage of revenue. So this is a little bit of a variable cost, but not directly tied to like the number of wells drilled and ongoing wells like this. But you might have some other costs that you want to like basically just have it go into a bucket and it just equals a percentage of revenues. So in that case, maybe 2% is accounts for something and it'll just multiply by the total revenue, and we'll do it based on uh, revenue after royalties. So it'll be based on this row here. And you can do a couple different items. Just do like 4. Usually if you're going to use this, you only use 1, but it depends. Maybe you won't need more. And that could be adjusted over time as well. No start month is just based on revenues. Whenever revenues start, these costs will kick in, whatever they are. And I believe that's it for fixed costs. I'm also going to fill in some data here just so we know it's working. Perfect. Okay. Update this. General. So really it's SG&A, sales and general administrative, but we'll just put overhead items, overhead costs or expenses. And again, this would be outside of anything you're defining in this section here. And really, I'm going to put title. So this is drilling extraction costs, just so we have some labels here. Okay, so drilling and extraction. Then this is deployment count and life. What else do we have here? Maybe we make these a little bit bolder. And then this is sales and revenue. Actually, that's all of this production. All of this is related to that. All right, and then this is just summary data. So it'll tell you on the end month, what's your percentage left of the initial flow rate that you're producing, how many units is that per day, and then how many total units did the well produce in this total life. And this number is going to be based on all these assumptions. Now, the reason why they're slightly different here is because starting on a different month, you potentially have a different day count, so you're going to see slight variances. Also, if this cohort of wells had a bigger decline rate of the flow rate, that's going to lower it quite a bit. You go from 3% to or 1.5 to 3. You're now losing, about what is that, 800,000 units over the life. And what's really cool about this is you can see the effect of the decline curve in production and how that's going to affect the cash flow over time. You could actually just run it for one well cohort too if you just wanted to do one, and that's fine. You could just zero out all of this other information, like clear contents here, and all the yellow cells you just clear. And you can actually just see what a single cohort looks like. So you've got these costs here, ongoing, and then the revenues produced over time. And then that would have some kind of IRR. Undo this, put these back in. All right, so we've got fixed costs. We've got all the deployment stuff all modeled. We don't really need a startup cost tab. We don't need any of the other fancy stuff we normally put in other models. This is very, very focused on just cash flow forecasting. Global control we do need. This is fine. Retitle this, main project assumptions. Now the end month, I don't know if there's actually, if this is relevant either, because, I mean, it could be. We'll allow the model to stop on any month, so if we do put this in here, we'll have to update some logic, but at least you can pick any month, and at that month, everything stops. Now there's no exit though, and like let's say you were building a software as a service business and you exit, there's going to be some value that you sell the business for. For this, you're drilling, the only value is really the assets you have because you've been selling all the, production. There's not really, maybe you have rights to different lands, but there's no nice and easy way to create a exit value based on that. So we're just going to show whenever you stop operations, just everything stops. And then all we're doing is valuing the cash flows over the forecasted period. So that's fine. That's really what the purpose of this is supposed to be. So, all right, so we'll keep going here. Just doing something real quick. Okay. So what we need to do on the monthly detail is, so exploration extraction costs, we need to put in corporate operating overheads, expenses, and this is just going to be referencing this. Also, I'm debating if we want to put revenue after exploration or not, or just flow all the way down to these. Like I said, it's not going to be like a traditional income statement. Total fixed costs. And then you've got other overhead. And we'll put total other expenses. And then here, it's not really net operating income. We're going to put taxes. I'm trying to think if it's relevant to what all we could really put in here. So we've got this, that. Taxes is actually going to be a hard-coded input. So you can put in here like, actually, yeah, this is not going to be gray. It's going to be light yellow with blue. So this is input. Good. Format all of this to our normal formatting. It's just going to be easier to have this tax row. It's just hard-coded. Income tax. And then we'll have cash flow. So this is the primary thing we're solving. Let's put, what's revenue look, what's the format we did here? Okay, top and bottom. Okay, that's fine. So for the overhead expenses, we want to say if the date here is greater than, or sorry, is less than the start date of the cost, then 0. Otherwise, just index the amount based on the year. And then we'll also say, and I'll have to update that formula, but we'll also put if this is greater than our stop month, then 0. Okay, what? Oh, E2. So we know we need this to be there. Lock this. Lock that. That can roll down, and this is locked. Fixed cost should be, I believe, row 4. Oh, nope, 5. Now we have an error. What's going on with this? So if E5 is greater than that 0, otherwise if E5 is less than fixed cost C6. Okay, that's fine. Indexed fix match. Yeah, that should be. What's wrong with this? If I not able to the formula function. Okay, let's delete this. So it has to do with the index formula. That's our lookup. Oh, shoot. I see. Oops. So we are indexing the year, which actually is 2, not 5. And now we have a value. Nice. So there's these costs. Now why 4444? Okay. Let's drag this over. Now to make this work, it's really easy. We just drag it over all the way. And then this just goes down. And I have arbitrary numbers in here just to make sure the formulas are working. Looks like they are. We pull in these total fixed costs. Now for this part, we're going to pull the percentage, and where are we at here? This is 175. So this, we don't need the first or the second if on this one. It's just based on a revenue. 175. Okay. And then we'll multiply that amount by the gross revenue. Oh, and we need to lock E15. So, really excited to get this template out. I've actually worked with the oil and gas guy recently, and I know this template would be insanely valuable for financial planning for that. Now, total expenses, we're going to say this plus this, whoop, this. And again, there's other costs here. The exploration costs, these are probably going to be the biggest costs, but still we need to account for overheads as well. Okay, so there's that. Income taxes and then cash flow. We're just going straight into that. It's going to be total revenue plus this, which is always a negative. Well, I guess if we're making all the costs negative, we can add up everything. So let me just format that the same. So this is going to be plus that. Actually, we can take the whole thing here plus this. And then this should be a negative. Okay. And you have your cash flow. So if I had taxes being paid here, I'd put negative 5,000 or whatever it is. Enter as negative. Let's bold this first of all. So these, we're just going to have them flow through as a negative value. We just plug in a negative right in front of the index. And let's drag this all the way over. Okay. We can hide or group these in case you want to hide and unhide. We'll do that to all the major sections. And watch when I hide those groups, you can see, let's just drag all this over first. You'll be able to see in detail. We'll do an annual detail as well. Oh, keep these 0. let's say we're going to stop this within 10 years. So we just do 2023 to 2032 forecast period. We can do dated if. I believe we go start, end, oh, other way. There, divided by 12 is the years. Uh, we want to parenthesize this. There we go. 10 years. So that's relevant on here. Now let's see if this worked. Yep. Okay. So the end of the 10th year, everything stops. Now what we'll have to do is put in logic here. So this also stops. Now all this is just running out the matrix tab, so I don't have to do any crazy stuff. I can just go right into here on each of these and put if our date here is greater than the end month, 0. Very simple. And this is what's nice about doing all the hard math separately and then aggregating it into this tab. It's much easier to build logic around. Okay, now I should be able to do the same thing for these as well. I should be able to drag everything over. Okay, make sure nothing's messed up. Oh, what was that noise? Either somebody subscribed or actually I had my first on-stream donation last week. It was kind of crazy after 2 years of doing this. Okay, does this work? Yep. Looks like it was a subscriber. Cool, welcome. Welcome on in. And no, so after this oil and gas cash flow model's done, I plan on doing either I was thinking of doing a cap table, just a standalone cap table with a lot of data, like database style, where you can have 100,000 thousands of investors that you're tracking their ownership of, and it has a bunch of stuff. I don't know, we'll see, but that might be what's coming out next. Or feel free to give me suggestions on what you guys want to see me build. I love new stuff, new logic I haven't done. Like this oil and gas deployment schedule is really awesome. It involves some new things. Uh, really happy with how it's going to turn out, and it's super useful. It's simple. Now look at what happens here. If we hide this, you can see all this in one shot. So you've got how many active wells you have, what's your gross revenue, what's your total cost for exploration and extraction, what's your overheads, what's your cash flow. And let's make sure this is all correct. So this should be this plus that plus that plus that. Now this is summing up these two. Oh, nope, we got to make those a negative. So good thing we caught the error there. So these all need to be negative as well. Now, one reason why it's nice to make all the expenses negative and all the revenue items positive is because then you could just sum everything up and you'll get your net amount instead of having to plus and minus stuff. Now, what I'm actually curious to see is the annual flow. It's going to be nice to see, it's kind of satisfying, and then the IRR waterfall. Okay, so there. Now these costs. Okay. Okay. I believe that's everything. We have revenue, royalties, all this, overheads, and then some overheads as a percentage of revenue, and then taxes and cash flow. So this is pretty good. It's a pretty simple view, and you can really see, okay, what's because a lot of times this is just equity investors are going to be doing this. So what equity do I need? When do I need it? And what's my return look like? And then the really complex stuff is in the deployment schedule, which you can all modify based on your strategy and plan. Now we can do some metrics here, like so we know how many active wells will exist at any one time. So we could say, monthly, one stat could be average gross revenue per well across the whole portfolio. And to do that, you just take the gross revenue divided by the well count. And this is all dynamic. So when these wells fall off based on the schedule input on the deployment schedule, when they stop, that updates. So you can see we're going up, 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 and then it starts to go down when some of them come off. It depends on what you end up putting in column D here or column F and E for length of production and count, and then the success rate. So this will be per our dollar amount, and we can actually put this into a currency. We're going to display it. So average gross revenue per well. Now, if you wanted to get another thing, I think is average gross revenue per well, and then average. Average. What do we want to call this? Average and net revenue. Now on average net revenue, it'll be a little bit different, and I think it is worth it. We're going to actually format these as the same as the rest of this. So net revenue per well is going to look at the total wells that are being produced or extracted from. Then we're going to do, instead of just E15, we're going to take out, look at this, we're going to take out the ongoing costs once you're producing. So these are successful wells that are producing. Here's the royalties you're paying on those, and then also here's your ongoing costs as on the producing wells. So we're taking out that cost, and then we're seeing the real, like essentially what that well is producing every month, or what the average well is producing every month, which will always be lower than this number. And it's going to be dependent on all the assumptions you put on deployment. So that's a very interesting metric, I believe. We'll put that in a chart. We can do that on a monthly and annual. So you can see here. Now what this is interesting is against the flow rate and the decline curve, production decline curve, you can see at what point, based on all the assumptions, are your ongoing well activities not covering your ongoing costs of those wells. Now, we're not taking out ongoing exploration costs, initial exploration costs, or initial drill hole costs, because those aren't happening alongside uh, successful production. Only this last one is. This is like you get the well in there, you're extracting. Okay, now as you're extracting, what are you costing per month? What's it cost per month, and what are you making per month? And then this top number is just looking at the number before your ongoing costs. So, like if we were to put, let's say we put this at 3% decline, you can see the numbers change quite a bit. Let's say 3% per month in flow rate decline. Now, I don't know if we'll get a negative. We've got a little negative there, but that's because you've got deployments happening. And any negative period will be a cash contribution requirement by equity. Any positive month is a distribution. So this is still 600, 500. So even at a 3% monthly decline, these are still profitable the whole time based on our assumptions. Okay, so we got some advanced metrics in here. I don't think we need to get like, I mean, we could get, what else do we have in here? Value of units produced, active expirations. No, we don't need to pull in like trying to figure out this percentage on a given month. Okay, so now let's turn this into an annual sheet. So we have the monthly detail. We go annual. Now in order to have the most accurate cash flow waterfall, like if this is a joint venture, which it doesn't have to be, but if you are using a joint venture, then we're gonna have to use monthly cash flows, not annual, to get a more accurate view of the return on cash and correctly account for that. Okay, so there's 20 periods. We can clear out the rest of this. I'll zoom out a little bit. Okay, so on an annual basis, we just need, let's see, so this is, let me look at what this number is. So this just, we can pull it over to the annual with the index formula. Total exploration's done. We could sum this up by month. Now, what is this number? Active, oh, active drilling. So this is what you're drilling actively, and that's the index. So index, sum, index. All right. So here we just take the end year amount of this, match, I think it was E5, E-date, E5, comma 11, which is the end month of the year, against this row. Okay, lock this, and this. So we can use that for these two calculations. We also need to make these a different format. This is now 12 months per period. Days is not relevant. Quarters is not relevant. This is the year. We can keep the year number, month number. Okay, and then we can format these. Okay, so there's 20 years. We have our index formulas for these two. This is going to be sum ifs, and now from that we should be able to calculate all these other line items. Here, if. Okay, so this is a nice summary. Here's how many explorations were done per year. Now hold on, this doesn't make sense. Why is this aggregating higher and higher? Let me go back here. Oh, I see. This is doing the total amount that have been done. So what is this doing? Matrix C 494. Ah, I mixed them up. So active exploration. So this is the count. This is the total explorations done. So 9. This formula. Let's move this over here, and then this actually moves down. Okay, now this doesn't make sense either. What the heck? So here's. Wait, what? So let's change this too. So sum 9 or sum 8 and then index 9. So this is summing 8 and then index is on 9. There we go. So there's the total drillings that are done, and here's the total, and we got to change the labels here, but now the numbers actually make sense. So at the end of each year, I can quickly see, well, here's how many explorations I did, how many drill holes I did, and here's the total. Now, why doesn't this make sense? Active, this is the total. This is what's actually active based on our percentage of success rate. Done. Now, what is this? Active, what did I do here? Active exploration drilling. This is 494. Wait, this is the total that's been done. So we need to sum up 8, right? So we're summing this up. This is the total that's been done. What is this number? Sum if deployment F if C is less than, oh wait, so that's also the total. So confused. What was I doing here? I know this number is good, the active wells. I know this number is the, in theory, did I do the formula wrong? Let's look. This should be F if C is less than or equal to the month number. So total F if C is less than the month number. Total of F, and that's the start month. So 10, so at month 2 we've done 20. We did one in month 1 and one in month 2. So, yeah. But we drill for 4 months at a time. So, let me go back to my matrix. This, what's in 495 is the current active explorations. So here's how many, okay, what's annual? So this is also an index. So at the end of the year, index 8, this is how many active sites are being explored, but not we don't know if it's a success or not, but that's how many sites are being explored at the end of each year. And it's 10 because our pattern goes, you can see here we start 10, start another 10, start another 10, start another 10. So we have 40, but then they fall off, and at the end of the year, we only have 10. Well, in year one, it's actually 0, but if you go to the next year, you can see the pattern is basically ending on 10 active explorations. Now, so this is different. None of this is saying the total, well, this is saying the total explorations that have been done. So this needs to be a sum. Or no, this actually can be an index as well, and here's why on the annual tab. We can index this because this is the total that have been drilled. This is what's currently being drilled. This is the total that's been drilled. So they're not directly related. This is just, okay, we're drilling these to search, and this is how many we've drilled so far. Now, what I have not put here is the count of drills done per month, which we can do. Let's actually add that in here. We're going to add that to the top. First, let's make sure this is still right, though. So this is saying this is how many we've done in total. So we drilled 400 holes. This is the total active explorations at the end of each year. And then this, we're going to say, is explorations done drilled per year. And then this is explorations drilled per month. Now the per month, we can easily calculate. It's just sum ifs, deployment, F. We just want to know what is in F if the start month in C is the month number here. And that's important too, so you can see like on a schedule how many drillings are you doing, and they're all 10 because we just put on the schedule 10, so that's fine. So 10, 10, 10, and then this should sum up to the total 50, and then if you keep going, here it's 80, yep. Here it's 130, so see that's matching up with this total explorations done number. So that's great. And then the annual, we got rid of our sum ifs. We got to add that back in. So this is sum ifs, explorations drilled per year, if the year, and 2 matches E2. And that should add up to 400, which it looks like it does. I've done this many explorations. There's this many explorations happening at this time. I've done this many exploration drills per period. What about, I want to see, and we're going to have to group and ungroup this. So let me put the group. I want to see how many successful drills happen per month. Successful drills based on the success rate. Now this number is tricky. We might have to do some advanced calculations here. So let me think about this. So how do we know the amount of successful drills that happened? Let's go over here. I know I have to have this data because we have to, okay, wait a second. So we have count deployed. All we have to do is multiply this by the success rate of each cohort. Do I not have that anywhere though? Initial success. So I did age. What did I multiply this by? If F13 is less than equals 1, then oh, I see. K times H. So I did one-time drill cost times success rate. Oh, H. I just sum up H. Okay, so hold on. So we can just actually do the same formula, but instead of summing up F, we're summing up H. So here's the successful drill holes that have been found. So all these will be good to do in visualizations. And it's a nice way to say you can define the data here and the percentages, and then you'll output these nice monthly and annual charts. Let's ungroup this. So I find 8 in year 1, 5, 6, 6, 6, and then year 10 is when we stop. All right, perfect. So now we have all of this information. Exploration is drilled per year. Oh wait, that's not that. What are we calling this? Successful drills. Successful drills, total explorations per year. Active ongoing explorations, total explorations done, active producing wells. Now what we can also put in here is our average success rate, which right now is just 15%, but let's say the success rate is different for each cohort, then you're going to want to know an average success rate. So we can put that here. Equals, and that we can say is total drillings done. Well, total successful drills divided by total drills per period. Now, we do need to fix the wording on top there. You can see the one thing said year, but it needs to say month. So let's fix that. So 15, it should be 15 every time. Successful drills, explorations drilled per month. Okay, that's fine. And then this will match this. And it's just 15% because we defined that for each one. If, let's say the success rate on some of these were 25%, you're now going to see a different average at the bottom. So see 15, 25. Annually, it's 21, 18, 15. Now why? Oh, we haven't done the rest of this yet. So let's pull in the rest of this annual data. So unit sales, royalties paid. This is our annual data, cost, all our costs and fixed costs, and then we can see what the cash flow looks like on a 20-year period. So this right here is probably enough for most, but we're also going to do a cash flow or joint venture waterfall. There, okay, and then these are summing up. Now this should, just to do a quick check here, so 1.3676 billion. Okay, good. So these are the same. That's good. So on the cash flow on an annual basis, they're actually all positive cash flows, but obviously if you look at a monthly, you do have an initial investment and then you have returns happening. So that's why we're using a monthly cash flow detail when we go to build the return on investment calculations and all of that stuff. And the internal rate of return. So IRR you can actually calculate right here. This is going to be the monthly. And I'll put this in more formal views, but I just want to show you like this is internal rate of return, which is very high, 13% monthly. That's a compounded return rate. And all that is the discount rate you have to apply to the future cash flow, so the net present value is 0. That's what the definition of internal rate of return is. Essentially, it's a compounded rate. Now that's monthly. The annual would actually be, let me see if I remember how to do this. I don't do it a ton. 1 plus the rate raised to 12 minus 1, I believe is how we do it. So yeah, it's like a 300% IRR annual. Now everyone thinks of IRR in terms of annual, so that's why you got to convert it. So 316% annualized or internal rate of return. If you're looking at just annual cash flows, well, you can't. There is no, you have these costs happening over time. There's just no way to really nicely do it on an annual basis unless you just aggregated all of these initial costs in period 0 and then isolated only one cohort and then looked at the cash flows, which you could do, and that's fine. But this is looking at a scaling model that has these costs happening over time, operations happening over time, so you have to look at the monthly. So this is pretty good. I mean, all the value of the model is in how this becomes dynamic. That's something that's not easy for anyone to just go and do. If you're decent at Excel, you need to know a lot of advanced techniques for modeling to make this work. So that's where the value of the model is. You can enter this stuff. Really not a whole lot on the global assumptions. I might put some more output stuff here. We got some data sources on what exponential decline is and some other resources on oil and gas well drilling. Just some timing assumptions on this global control tab. You got your fixed costs. So this is really good. I like this. It's very simple. Anyone can understand the template outputs. Oh, let's do so the taxes here are going to be summed up based on the monthly inputs. And we'll make a note here. Defined in monthly. Defined in monthly tab. I think that's the easiest way. And again, you're going to have the only thing that we're not doing is automatically calculating depreciation. But the only effect that we'll have is on the taxes, and the taxes are just going to be hard-coded input per month. And the reason why we're doing this, you've got these initial exploration costs and drill hole costs. Some of these are going to be fixed, some are going to be or capital asset purchases, and some are going to be like renting, labor, all that. We're not separating all that out. We're just trying to get the cash flow. And again, the only difference is on the cash flow side is you don't see depreciation, but that's why I'm having income taxes manually entered. I think that's the easiest way to do it. Okay, so we've got that. Um, Average success rate, average gross revenue per well, average net revenue. Yep, those all make sense. They're just on a per year basis here. Now you could run the model like we stopped at after 10 years. You could run this thing all the way through to 20 years and you could have data here. We basically did drilling up to 2033 and then you just running the wells after that on an 84-month life expectancy. And there's the cash flows. You've still got your IRR here, 316%, which is good. Again, no exit value, just drilling the wells and figuring out what they're worth over time. That's what we're showing here in a very, very dynamic strategy planner. So what else do we need to do? Visualizations. I'll do that tomorrow. We need to do maybe some global control tabs. We needed to do the IRR waterfall. Um, if you have a joint venture. I'm also going to do a not like an advanced joint venture where you just say GP and LP contribute X rate and GP and LP get X percentage return, no hurdles. So that'll be one option. Then the other option is the more complex joint venture structure with the hurdles. Okay, really great work today. Template tomorrow. We will finish it on stream. 10 a.m. Eastern is when I start. And then this thing will be up for sale by the end of the week. I think I'm going to sell this template for $75. That's a good price point for the value it gives, and um, I think that's fair. All right. Don't forget to check out more financial models at smarthelping.com. The startups tab is where I will put this template when it is finished. Under oil and gas, it'll be in the O's. This is all alphabetized. And remember, if you want to buy, you can actually get every template I've ever built for $9.99. And that includes access to future templates I do build as well at no extra charge. Super ton of value there. Check it out.